Hi, Quentin. How are you today?
Good, Dahlia. How about yourself? How are you?
I'm very good, thank you. I appreciate you jumping on this call on a short notice. I know both you and I are informal today, and I thought, you know what, let's get the content out to investors because there is a lot of questions coming through about the rate changes and the uncertainty in the environment ahead, and getting timely content out to share with everybody is key at these times. So I appreciate you jumping on the call quickly.
No problem.
Quentin, you've been investing for a very long time. I've observed you invest in several asset classes and different strategies. So you're a guru in when it comes to investing. And I wanted you to share what you're doing right now as an investor, given the shifting environment, given the quick rate increases. Is that impacting your cash flow? What are you doing about it? And how are you navigating this environment that we're in?
Right. So, what I talk about a lot is being proactive rather than reactive. So, when we are purchasing properties, we're purchasing properties for cash flow in appreciating markets. And that cash flow gives us the ability to withstand rate increases. So, one of the things that we do proactively is stress test our portfolio to 10-year rates. And so I've been doing that for years, and that's helped me to understand what's going to happen as interest rates increased. So I am in a good position from a cash flow perspective to withstand those types of increases. So what I've been doing over the last few years is also telling people this is the time to be applying for lines of credit. This is the time for getting cash. We also were proactively selling properties over the last 2 years. So we sold, I had some condo townhouses that were left. I think I had three or four, sold them all. So we have a good cash cushion to be able to pick up opportunities, because this is where the patient investor can take advantage of opportunities. Now, what you want to be able to do is, if those prices are coming down and rents are staying the same, you're going to be able to pick up properties now in great neighborhoods that are cash flow positive. And, even with the interest rates being the way they are. So if you can do that and you still can do a little bit of stress testing when you're purchasing, expecting higher rate increases, then you've got a great investment. Because don't get scared about what the media is like telling you, and interest rates are doubling, like
The
this
hike, the
it's
hike.
gonna go up 200%. Well, 200% of, like, if it was 25%, 25.25%, and it goes up to 0.75%, yes, it's gone up 200%. But in reality, look at long term what rates have been, right? Not just what it's been over the last 10 years. So you have to keep that in mind as well. The other thing is that don't panic. You want to be able to understand why you invested. What are the fundamentals of the markets that you're investing in? If you're investing in good quality assets where you have population that's coming into the area, right? And it has job growth, it has population growth. There's something that, like, all of those, although all of those things that are happening in that area should attract you to continue to invest in that area over the long term. Don't make 10-year decisions based on the last 30 days of news. It makes no sense, right? Make 10-year decisions based on the economic fundamentals of the area, and buying good quality assets that you're going to hold on for a long period of time. The last few years have been pruning years, where you should be taking those things that you didn't really like in your portfolio and getting rid of it. Now, what you should be doing is looking at opportunities that are coming up. Now, the residential market, 1 to 4 unit market, is very different than the commercial market, which is 5+ units.
Yes.
So what's been happening in the residential market, particularly in what let's call suburbs or secondary or tertiary markets, we've been seeing, doubling of values in the last 2 years, and now we're giving back 25 or 20% of some of those gains. So we're going back to like what would it look like in perhaps September of 2021, and it's July of 2022 right now. But so we've given back some of those gains, but remember, we still doubled in value from where it started.
Yes.
Right. But we also still have to remember, when we're buying for cash flow in an appreciating market. So there are opportunities that you're going to be able to take advantage of in great markets that have all those fundamentals that you want to look for: job growth, population growth, and some limits to the development, green belt areas that are causing development to push into different areas. Incomes that are above the provincial average, all those things that make an economically great area to invest in. So there will be opportunities. This is where you have your cash. The problem, there is a little problem, though. There are investors who are waiting for like the correction. So if this is the correction, what are you waiting for? Do you know what, like they're going to be waiting forever. I hear about, there's the bubble people. All right, bubble people. So we've seen a correction now. Where is the bottom? Like nobody, that's not what you should be focused on. What you should be focused on, buying good quality assets that are cash flow positive in appreciating areas. And if you can do that, and you have a longer term point of view, it doesn't matter whether interest rates go up. The other thing is that there is a little secret that most people don't understand in commercial properties, where like I'm focused right now on buying apartment buildings. I have been for a little while, and it's definitely something that's a little different. So interest rates are going up, but cap rates are staying the same. They're not really changing very much, right? And typically cap rates are based on location of the building, quality of the asset, and interest rates. That's usually what makes up cap rate. But cap rates aren't really changing, and people are asking for the same amounts that they were 6 months or a year ago. Now we may see that change, but right now that's not the case in commercial, call it 5+ unit properties, right? And so the difference is that if you're buying in a rent controlled market like Ontario, and their market rent is $400 or $500 difference than the actual current rent of the property, your business plan is really just taking that $400 or $500 increase and bringing it up to market. Those other increases that happen over the next couple of years based on whatever 2.5% that the government, it's not really as important as turning over those units. And that's fulfilling the business plan. So interest rates, in the grand scheme of things, aren't as important in that space as being able to complete or fulfill that business plan, because you're still earning our returns, and you're still, having your money work for you. Would you rather put it in the bank? Like, would you rather put it in GICs? Right. So, you still want to have that money working for you. Because, if you're borrowing at 5% and the CPI is 8%, what does that say? It's saying that inflation is being able to rebuild that same building is impossible at the current price that you're buying it at. Yeah. Right? That's what it's saying. And the challenge is that a lot of projects with inflation, with the things that are happening, are going to be shelved. So I think that builders are going to shelve a lot of projects that they probably were planning on doing. And I think that the government is going to be in a predicament, because there's going to be a lot of people that aren't taking advantage of those commercial construction financing projects that CMHC wants so much for people to take advantage of, because of the risks that are involved in it. So the existing stock is going to be worth more, particularly in the 5+ unit space. So in the 1 to 4 unit space, take advantage by buying cash flowing assets in good quality areas that are appreciating and cash flow positive. And then in the 5+ unit space, the ability to be able to take advantage of the spread between whatever the building rent is and the market rent is, and being able to understand how you can purchase at a cap rate at, let's say, a 4 cap, but have those spreads, and you have 2 or 3 units turnover, and all of a sudden, the building value increase, $300,000-$400,000 because of the spread in market rent. And that's what we're finding is happening. We have a building in Midland that's closing in, I believe it's in September, and already 3 units of the 12 units have given notice to turn over. So we haven't even taken possession of the building, and we're already getting $400 or $500 bumps, right? And so that's the advantage that you have in this market, that in other markets where you don't have rent control, and people don't really talk like this, right? Because everybody talks about, like it's a problem. But if you can find the opportunity, then you have a business that I think can succeed. So, going forward, if interest rates are a challenge for people, that could mean that there could be buying opportunities in the future. So look for your opportunity in whatever challenge is being presented. That's the way that I look at things. I want to find the opportunity in the obstacle. There's a great book, The Obstacle is the Way, right? And this is what we do in our business. And what you can do as in an investor is to look at don't look at the interest rates as the obstacle, look at it as the opportunity for you. And
I love that. I love that.
Yeah.
That's a new quote that I'm going to write down. Don't look for interest rates as the obstacle, look at the opportunity.
Yeah, absolutely.
Fantastic, Quentin. I love how you touched on several key points here. One, staying calm and strategic. 2, you sold your properties to line up cash to pick up opportunities in this market that we're in. Some investors are still holding on to some residential properties. And do you feel that it's worth their while right now to set up line of credits on these properties where possible, so they can jump on the opportunities ahead, despite the fact that values have come down a little bit?
Absolutely. You should have been doing that all along. You should, and if you haven't already, you should definitely be doing it now. You should be accessing that and locking in some of those opportunities, because that way you're able to take advantage of whatever the appraised value is at this time versus what it may be 6 months from now.
Yes.
And be able to access that equity, because things are changing. There's lots of rules, like OFC brought in some new rules that'll be implemented starting in October, and then will be
the advanceable mortgage products. Yes,
exactly. So don't wait. Get it done and then have it in place so that you can have that flexibility later on. And strategically look at your portfolio as a whole, and be able to see, stress test it. Like if you feel that you have to lock in a variable to a longer term fixed because it makes you feel comfortable, then do so. It's better to sleep at night than to feel like you're in a roller coaster because of interest rates. I'm not that. It's not that I'm not that concerned. It's that I've stress tested my portfolio, so I feel comfortable enough where I'm at and what I'm doing, right? So that's what you should. It's an easy way to add comfortability, or take your variable, turn it into fixed if you need to.
The differential. So I love how you said, if you can't sleep at night, you may consider locking in. And there are investors like this on the street. They can't sleep at night every time the Bank of Canada raises the rate, regardless of how much they stress test their portfolios. They get that anxiety and they can't sleep at night. And locking is one option, but the differential between fixed and variable 5 years right now is very large. It's close to 200 points. And one idea to lock is to lock into a shorter term fix, like a 1 or a 2 years fixed. Yeah, Quentin, thank you. You've shared several great points here. One last question for you. If you were to share one tip for investors to wrap up, the biggest tip, what would that be?
The biggest tip for financing, or the biggest tip for
I don't like to use word pivoting, for adapting and thriving in this environment that we're heading into?
Yeah, so I would say don't look at interest rates as the obstacle, look at it as the opportunity to be able to find out what you're, when prices increase, that just means that for some people, it's going to take them out of the market. And that for you, that could mean opportunities to buy properties that make sense. So buy quality assets and that are cash flow positive. I've been saying that for years, right? And it works. And because you want to be here 20 years from now, you don't want to be taken out by bad financing. Takes out like families, right? So don't get into bad financing positions, over leveraged. Those are things you have to watch out for. So don't over leverage. Here, that's a good one.
Don't over leverage. Look at interest rates as opportunities, not obstacles. These are my 2 key takeaways from what you shared with us today. Thank you very much. And we appreciate you jumping in and sharing your insights.
No problem, Dahlia. Anytime.
Okay, Quentin. Bye.
Bye-bye.